Hello, I'm Greg Bell, and welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights that boost your trading potential. Coming up, markets have whipsawed from policy uncertainty to strong economic data to sharp tech sell-offs. Investors just trying to make sense of it all. Just a few minutes when we're joined by Kenny Polcari, Chief Market Strategist at Slate Stone Wealth, to help break down what's really driving the volatility and what matters most right now. Plus, a breakout or a bull trap. We're taking a closer look at the Dow in today's technical take and the key levels that could decide the next move. That's all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. We're half an hour into the trading day. Let's check on the S&P 500. We're down about 0.75%. We're continuing to see pressure in some pretty big tech names. We also got some fresh numbers about U.S. layoffs for the month of January, the worst start to the year for the U.S. for the labor market in terms of layoffs since 2009. You got Bitcoin, a lot of volatility there, below 70K. Let's jump into the heat map, check out some of those big tech stocks, and you can see they're not doing us any favors today, whether it's a Microsoft, NVIDIA is basically flat, a Google, and Amazon. Let's jump deeper into Google, or Alphabet, as I'm supposed to call it. It was actually a beat on both earnings and revenue for the fourth quarter. So what is the concern? Huge capital increase being projected for the year to 175 billion, maybe even up to 185 billion, more than double their 2025 spending. Of course, that's about the AI push. And it's interesting to see companies either rewarded for spending a lot on AI or not rewarded. The situation today seems to be, yeah, that's a lot of money. Is it going to pay off? Qualcomm, want to jump in on this one too. This is interesting. Global memory shortage. We've been talking about that, and Qualcomm's customers are getting a little bit cautious, and it's hitting their outlook. So these are smartphone customers. They buy Qualcomm's processors and modems, and then they pair them with memory. But those data centers, so hungry for AI, keep buying up all the memory. So that's weighing on the forecast and weighing on shares of Qualcomm this morning. And that's your market update. Joining me now from London, Ontario is my colleague Hiran Amin from our direct investing educational team. And from Jupiter, Florida, we're joined by Kenny Polcari, Chief Market Strategist with Slate Stone Wealth. Before we dive into the conversation, gentlemen, just a reminder to our viewers that the views and forecasts expressed are solely those of Kenny and his team at Slate Stone based on their research. Kenny, what is the market trying to price right now? Is this fundamentals? Is it liquidity? Is it fear? Help me out here. Help us all out here.
Listen, I think it's a combination of all those things, right? It's a little bit fear in the fact that tech has been a stretch trade for a while, but yet it has refused to reprice itself, but it is now. It's fear, and it's this new appointment of the Fed chair and what it really means for the Fed, what it means for policy, what it means for the balance sheet. You know, while he can cut rates, he's got to shrink the balance sheet, and how can he do that without creating chaos? So I think that's part of it. I think now there's suddenly this fear about all this CapEx spending. You know, last quarter they couldn't spend it fast enough. They kept being rewarded. This quarter they're spending it more than expected, and suddenly they're getting hammered. I think this is the pendulum swing, right? It's gone way too far to the right. Now it's going to come back to the left. It overcorrects on one side and it overcorrects on the other side. So I think you have to. I don't think the story's broken by any stretch. I think you have to be very specific and strategic with individual names. But if you stick with the biggest names in the sector across, you know, software and tech and ad and Amazon and all that stuff, then I think you'll be all right. But you have to be prepared to ride this wave. And as a long-term investor, you should look at this as an opportunity to buy some really good names that are on sale. And they might get a little bit cheaper, but you got to start picking away if you're a long-term. If you're a trader, you love the chaos, right? You want to see it go like this more and more because that's what you do as a trader, right? You take advantage of the short-term moves.
Your note this morning, when love turns to liquidation, I love the title because I was going to talk about the fact that you see opportunity in this market. Short-term traders, you say, love this kind of volatility. Longer term, right, there could be some good names on sale. So you're not afraid that there's something deeper going on under the surface here? Talk to me about the rotation.
No, and I think you have to just look at the rotation, right? It's clear to see that money's not coming out; it's rotating to other sectors. Look, industrials. We're only 32 days into the year, 34 days into the year, and you've got industrials up 9.5%. You've got financials up. Let me just look here real quick because I want to make sure I'm telling you the right thing, right? But you've got industrials, financials. You've got energy up 18%, and you've got basic materials up 12%. So money has moved into those sectors, and quite honestly, those were sectors that were not the best performers last year, right? The ones that were the best performers last year are the ones that are actually seeing some money rotate out, and that makes sense because they were the best performers, and the industries and the sectors so far that are leading the way were the ones that were kind of the mid performers, maybe an underperformer. Consumer staples, which is up 12%, was the big underperformer last year, did nothing. But now what this tells you is that people want to move out of this kind of tech trade because it's been so great for 3 years. A lot of people have made a lot of money, but now they want to take some of that money and rotate it into the cyclical sector. So look at the industrials. A name like Caterpillar Tractor is up 20% year to date already. And I think that just speaks volumes to kind of where money and where investors, at least investors, want to go. Trader types are going to go wherever they can, wherever there's volatility, because that's what they do. But the investors are moving into kind of the more cyclical trade and really kind of some of the boring stuff. Consumer staples is probably the most boring sector other than utilities that's out there. But look at the action so far this year. And utilities, by the way, which was a great performer last year, is one of the underperformers this year. But consumer staples and basic materials are shooting right to the top. So I think there's opportunity for sure. And I'm not worried about this broader, oh my God, there's going to be this crash coming. I think there's going to be this rolling rotation. But I think in this rotation, you're going to find great opportunity, especially in the tech space, because I think we're in the very first innings of this game in terms of tech and AI and where it's going to go. That you're going to get the opportunity to buy some stuff on what I consider a fairly decent sale.
Well, and Kenny, let's talk about the sale what's essentially spurted. And you talked about Kevin Warsh for a second, but there was something else this week that also happened by the name of Anthropic. Obviously, we know this is they built a large language model AI, LLMs, and that news triggered broad selling across the software, the semis, cyber, even private equity names. Everyone just got caught up in anything that was attached to software. Is this really, in your view, a systemic AI disruption play where LLMs were just supposed to be adopted into enterprise and help them improve their productivity or tech stack, but now are they out to get their lunch and compete against them? And what does it really say about the structural AI shift for you?
Well, so I think there's a little bit of that, right? Because they recognize that there was an opportunity. Look, this whole tech revolution that's happening, is very fluid, right? And so the Anthropic news really caught a lot of people by surprise. But on the one hand, should it have really caught people by surprise? Because we've been talking about, some of the things that the large language models are going to be able to do. They're going to be able to do analysis. They're going to be able to, read through medical reports. They're going to be able to summarize all this stuff very quickly. So I wasn't necessarily so surprised in that. But the fact that now that they feel that they're going to compete with them is obviously kind of changes the landscape a little bit. I'm still not in the camp that I think that's going to happen. I think there's more room to go, so I'm not necessarily worried about that. But look, it is changing the face of technology. It's changing the face of how people use AI and how people are going to use this technology. But in the end, I think it's going to continue to do what we think it's going to do and kind of do all that rote, repetitive stuff. And leave some of the more strategic and interesting stuff to us, using AI to assist, but really to human beings. I think. Okay. I hope.
And let's talk about again on that AI theme, because I know the building blocks are in place, and we talked about making news rounds this week was coming back around that circular trade. Remember back in the day, NVIDIA investing in OpenAI, Oracle investing, you buy my chips,
right.
Left in from the right pocket, out of the left, basically. This week, that sort of narrative was falling apart with there's speculation coming about NVIDIA might not honor that full, their full commitment to OpenAI. If that were to happen, let's just say, because it's just verbal agreements right now, no equity is being purchased. If they say we're not going to buy it, what does this mean for that overall structure? Is it just built on weak foundation, and does a potential OpenAI collapse permeate through the entire industry then?
Well, that's interesting. Does OpenAI collapse? No, but that story, that circular story, how they're all, they're all dipping their toes in each other's playgrounds, is certainly very real. If it starts to come apart, then yes, I think you could see once again a repricing in the industry, right? Because a lot of the move up was based on that circular financing, because you saw it every time they announced it, the stocks surged higher again. And so if that starts to come undone, and I'm not necessarily sure it's going to come completely undone. I mean, Jensen Huang may pull back some of it. It may not be the complete number that they originally talked about when it hit the tape. But I think they're very dependent on each other. So I'm not sure that story is going to fall apart. So that doesn't concern me at the moment.
Kenny, earlier when you were talking about the rotation, defensives outperforming, and that means, there's opportunity in the market. The money's not leaving the market, it's finding new opportunities. There's some people I talk to, that makes them nervous. They don't like the signs that's sending about the economy, about the markets. If you have, say, consumer stocks outperforming banks, does it worry you at all about what's happening beneath or where we are in the cycle?
No, I think what that tells you is, when you look at consumer staples, I think what that tells you is people are coming a little bit more defensive and cautious. They're not as sexy as the tech names, right? Procter & Gamble, there's nothing sexy about Procter & Gamble. Yet, it is a good place, right? They pay you to own their stock. It's a consumer staple name that you need, whether times are good, times are bad. So I think all that tells you is that people are becoming maybe a little bit more cautious, that maybe they got over weighted in tech, and now they're recognizing with some of this latest news in tech that they should take some risk off the table. And that's what I think it tells you. I don't think it tells you anything about the economy being bad. I just think it's a shift to where they see the growth now, going this year. And I think it's more in the defensive cyclical sectors. The sectors, by the way, that were the underperformers last year.
And Kenny, coming to gold and silver now, that's obviously the theme of 2025. We saw it carry over a little bit into 2026 until the wash effect happened. We saw this parabolic move on gold happen. The news came out about the announcement. We saw the sharp, pullback that happened. So to you, does this look more, like a technical stabilization, which is what you've mentioned, or is this potentially a start of a new rally now that we've made up some ground? Barring silver, of course, it's still, having some pressure. And what does it tell you about the headwinds that are there for precious metals? We're talking about dollar liquidity and the durability of a reflation trade.
So gold is down $130 right now this morning, trading at 4,835. Now, if you look at over the last year, the dollar declined by about 12 or 13%, and we saw gold just rocket higher. Now, part of that was the weaker dollar. Certainly, part of it was all this central bank buying, China and India, and all these other central banks buying gold. For sure, I get that story. But some of it was also the weaker dollar. Now, the whole Kevin Warsh thing that, we saw what happened on Friday when they announced Kevin Warsh, the idea is that he's more of a hawk in terms of he wants a strong dollar, right? He's very inflation focused. And so the move is, remember, if the dollar moves higher, commodities should come down in price because that inverse relationship between the dollar and commodities. So I, in fact, think that gold and silver had gotten, certainly this year alone, they just went parabolic if you look at the chart. It's just straight up. And I think a lot of that was, partly momentum, partly it was all this, people just talking about gold like, oh my God, you own gold, you own gold, you own gold, I have to buy gold. They have to jump in, like that FOMO trade, fear of missing out. And look what's happened, especially the ones over the last couple of weeks. If they jumped in, they're licking their wounds at the moment. I think gold's going to retreat a little bit. I think the dollar is going to get stronger. I put it in my note this morning that if the dollar breaks up through where the trend line resistance is right now, I think it's 98.30. If it breaks up through 98.30, the dollar's going to get a fire lit under its backside. It will move higher, and gold and silver and the commodities should come down a little bit. Now, does that mean gold's going back to 2000? No, I don't think that's happening. But could you see gold come back into with a 3 handle on it? I think you could, depending on how fast the dollar may surge. And look, it's also going to that's also going to be dependent on the conversation that Kevin Warsh is going to start having. Remember, he's not the Fed chair yet. He still has to be, approved by the Senate, and then he's got to be installed, in May when Jay Powell's term is up. So there's going to be a lot of conversation between now and then as he positions himself and what his policy is going to be. And he's going to have to do a lot of hand-holding and dining out and trying to wine and dine the other Fed members to get them on his side so that they see it the way he sees it. So I think there's still time. I think that story is still unfolding, and people are going to have a chance to react. But I'm in the camp that I think Warsh is going to try to. He may cut rates, but he's also going to shrink the balance sheet, which is essentially leaving us in a neutral position. That will strengthen the dollar, and if the dollar strengthens, like I said, if it breaks up through that trend line, I think you're going to see the dollar take off, and then you'll see gold specifically and silver, other precious metals come in.
All right, so lots to watch there on the Fed and what kind of Kevin Warsh shows up. As someone had said to me, let's see which Kevin Warsh does show up. Last thing I want to ask you about the S&P 500. It keeps stalling at 7,000 support, trying to find some layers there. What are you looking at in terms of technical levels? What do you think the next, catalyst could be to get us out of this sort of pattern?
Well, I was, and I'm just going to confirm it right now just by looking at this, I want to see where we are. I thought we were in the 68, 67,000 trading range. 68, 60 was the short-term support line. We now busted through that yesterday, and we're now we're sitting right at top intermediate at 67.96. I think 7,000 is a resistance at the moment, but here's the problem. You're going to have to look. If we fail to hold this intermediate term trend line at 67.96, then I think it opens the door up, and we could see the S&P probably trade down in the mid 6,500 range, which is the lows in November, where I think it should hold. So today, right now, is a key moment in time for the market, because we have to see if, in fact, we hold this level. If we hold it, then I think it churns and churns, and I think the market settles down. But if it fails to hold, then I think the S&P is going to go lower. I think the Nasdaq will get dragged down with it. But I think what you have to understand is, while the S&P can go lower, you look at things like the equal weight S&P, which then takes every name in the S&P and gives them an equal weight, and then watch where the money goes. And I think you're going to see the money go into the industrials, the basic materials, the consumer staples, all the places where it's currently going.
Does that scenario make it hard to sort of put a number where you think the S&P 500 might be at the end of the year? Is it almost binary right now, either up or down?
Well, at the end of last year, at the end of 2025, our view here was that the S&P was going to return to this, 10 to 12% all-in return. So that would have taken us to something like 7660, 7700, somewhere in there. And so I'm still going with that. I think this pullback is an opportunity. Just like, remember, in April, when we traded all the way down to 48.37, some people originally had 7,000 price targets on it. They cut them down. JP Morgan suddenly went to a $4,500 price target in the S&P. Meanwhile, they got egg all over their face because the market just took off again. I think this feels like that DeepSeek moment. I think it feels like that tariff temper tantrum moment. And so I'm still in the camp that I think we're going to end the S&P is going to end about 10 to 12% higher all in, which is like between 7,650 and 7,700. Now, it's only February, so a lot can happen over the next 6 months. And so I'll reserve the right to change my mind depending on what happens with Trump, what happens with Warsh, what happens with economic data. But right now, the economic data in the U.S. is very, very robust. Right? There's nothing in the data that says we're going off the edge or the job market's falling apart. It is not. Unemployment is historic all-time lows, and the data, like PMIs, manufacturing services PMIs, are now in expansionary zone. Manufacturing just went into the expansionary zone, right? You got factory orders up, you got durable goods orders up, you got wages now rising faster than the rate of inflation. That's all good. And so, therefore, I'm still in the camp that I think while we're going to have some volatility because of a midterm election year, I think at the end of the year we're going to be in a better place.
Kenny, pleasure having you on the show. Hope we can do it again real soon.
It was a pleasure to be had. I'll be happy to come back.
We'll do it again. All right, that was Kenny Placari, Chief Market Strategist with Slatestone Wealth. And just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only and should not be considered investment advice or buy, sell, or hold recommendations. Here and lots there. I'm going to go into almost near the top of the show, and then we hit it again in the middle of the conversation. What he's seeing here, for all the market volatility, which does make a lot of investors nervous, a rotation, not a retreat from the markets. And then that follow-on, too, they're saying, so what if people are getting defensive? He's not seeing that as a bad sign for where the markets think the economy is headed. It's just like what worked before isn't working right now, and some of those defensive names are starting to work.
Yeah, exactly, Greg. I mean, as you described, the boring names are becoming, well, unboring this year at least. That seems to be the theme. And the market participants, interesting point that he made was the buyers just haven't left. They haven't fled to like fixed income or, gold and silver might be debatable there, but they're just rotating into these sectors that were just unloved for the longest time in 2025. Industrials, materials is what he brought up there. But the bigger thing that, that was the question in my mind and that was raised, and I think that's important for us to take. You remember DeepSeek, Greg, around this time last year, completely upended the entire market. And then this Anthropic news that has come up, I don't know if it's a DeepSeek 2.0 moment, but it certainly felt like it with the way that you just had the washout on Tuesday happen in the market and kind of permeate. But it really put a bow across software legacy makers and a warning shot in a sense that if Anthropic is doing this, what does it mean for those other LLM, providers, OpenAI? Do they want to get into the software space where they can easily do this? But the one thing that I'll mention is that they don't have the advantage of these other legacy software makers is they have their data in which they can build their application stack off of, which these guys don't. They have to go and buy it. So anyways, that's something to keep an eye out on, but we know for now, firmly we're seeing those other spaces getting some of the love there in the equity, across the equity sectors there.
It was like Kenny was saying, right? Sometimes that pendulum can swing just a little too far. Maybe it'll swing a little bit back in the other direction. If you at home have a question for our guest or team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the platform risk-free by opening a practice account. You click on that Try TD Active Trader button, then when you're ready to switch to a live account, simply export your workspace and start trading for real. All right, time now for a more technical take on what's happening in the markets here, and you're going to take a closer look at the Dow for us. What are the charts telling us?
Yeah, let's talk about the Dow, Greg. Regarded as the blue chip index, some people call it the boring index, but we'll stick with the blue chip. I read an article recently that I think really aptly speaks to the story that Dow's been having so far. The headline was, AI is now reaching a stage of creative destruction. And that was evidenced on Tuesday. We saw that broad sell-off, rotating more into cyclical names over AI fear disruption that weighed on the market. It was fueled by Anthropic, which we've been talking about, seems to be the theme of the week. And that really split into financial services and asset managers as well. So anyone adjacent to software or had software exposure, it kind of spilled across the board. But when you think about this headline, AI is now reaching a stage of destruction, for many, for all of us who do use AI, we've seen the range of uses with research, coding, writing emails, and more. It really does signal that many of these tech firms that specialize in these areas will become useless middlemen. And it's just maybe a matter of time when that's going to happen. So that's why investors are turning to value. They see that narrative. They see the foreboding. Remember, the market's always forward-looking. So, places like consumer defensives, healthcare, home builders, railroads, etc. And that makes a bulk of what the Dow Jones, sectors are exposed to, and that's recently led to its outperformance. So this rotation is going to be meaningful. It was led by energy as well. We saw crude being buoyed up there. But when we look at the charts here, you can see, I've got the daily chart pulled up, Greg. So what we're looking at since mid-July last year, coming out of the summer, the Dow's gone into this strong bullish channel that we found. It's respected that bullish channel, barring the sell-off we had in end of November. But you can see that sell-off didn't really have legs because we still didn't get full confirmation. We didn't have consecutive closes down because we did start making higher highs on the third candle reversal over here. And pretty much by the end of the week on a weekly chart, this was still within the bullish channel here. And we've tagged this lower channel. Now, right now, the Dow's kind of just dipping its toes outside of this channel at the moment, sitting on the 21-day moving average, which is sitting squarely at the 49,000. So the key levels, and recently, the way I've described at least 2026 so far is just been choppy price action, just been very much range bound. But one thing I will mention that we don't have on these charts is when we look at ratios and technical analysis, we want to compare historically, how has the Dow done against the NASDAQ? And since actually it's just the ratio recently just broke above the 2 level, and this is the first time that's happened since June of 2025. So we are seeing more outsized performance happening on the Dow. But on the top side, I'm still looking at 49.7. That is the key level there that it's been rejecting off at least for in this entire year. So once it can break there, it's going to propel. Maybe the upper channel is where we tag it up, just breaking beyond the 50,500 mark. But on the downside, if we break and we're not able to hold this lower channel, we could test back the 48,500 level here, which will be key. It's another key support. You know, was a resistance area of resistance previously. It's acting as a support, so I do see 48.5 as if we do see a downside and we see some love being brought back into the tech sector. So that's the key levels I'm watching for right now when it comes to the Dow there.
Where did the love go? All right. Let's talk. That's sort of Kenny's notes this morning as well. He also got Reddit for us.
Yeah, let's look at Reddit. So they've got, you know, Reddit's known as the front page of the internet. They've actually got their earnings coming out tonight after the close, and that's why we're looking them for anyone who's uninitiated with Reddit. They're a popular online forum and discussion site. Almost think of it as a social and watering hole categorized around different interest groups, and that's where you go. But for the earnings specifically, what they're expecting on the street consensus on the top line is going to be 665.8 million. This does mark a 56% year-over-year growth. However, the story is from Q3, this is a slowdown because Q3 they had registered a 71% year-over-year growth. On the EPS, they are going to come in at 96 cents, which marks 166% year growth. But the big story you have to understand is Reddit. What is exactly their composition? How do they make money? And it is really based on the number of active user base that they have and the dual revenue streams that they have. That's targeted digital marketing advertising and also enterprise data licensing, which involves selling anonymized data to AI and marketing partners. And this is where the story unfolds because a recent report from Adweek showed that YouTube, which is owned by Google, parent company Google, or Alphabet, I should say, overtook Reddit as the company's as the primary source for training AI models. So that's interesting and what we'll see in that note today. So coming into this earnings, I think investors will closely want to monitor advertising revenue and trends. That's a bulk of their revenue mix. The daily active unique users that they have, the user engagement and licensing deals. They did register about 116 million daily active unique users globally in the last quarter. They're expecting to reach about 120, just shy of 120 million for this quarter. But let's go to the charts, Greg, and see. Let's see what's unfurling over here. I've got the weekly chart. I want to look at a top-down view first before we narrow in on the daily chart. But you can see on the weekly chart, Reddit did debut back in 2024 around $34. But ever since then, it's been making these higher lows on the chart. You can see this boundary is very well respected. These are weekly candles that we're looking at. But it has reached kind of a double top moment over here where we see it sort of rejecting at this 245 to 260 area here. We can call this a rejection. Now, if I just switch back to the daily chart here, and we'll see some more detailed price action, we can see what's really forming. That picture looks in the, I would say, medium to shorter term, a little bit murkier. So on the daily chart, and we've got a telltale bearish reversal pattern that's formed. This is a double top bearish reversal that we saw. So we saw this sort of M formation. Remember, we talk about W's as wins. Well, the M's are the losers over here. So in this case, rejected at this double top, we made a lower high over here. And then we had this ground, which is supposed to be the support area previously, which is now have turned it red to become resistance. So the 180 level is a key level. It did break below this. We're sitting below another, what was a previous resistance at 155. We just broke. It's rejecting off of that. So I've marked this as a resistance. Now, one thing I'll mention lastly in passing, Greg, is when you look at this pattern, we always want to gauge how far could this stock fall before we see demand shore up. And we're basically able to take the tops of the pattern and with the neckline or the baseline and measure it. And right now we're predicting a $55 move down. So we're going to go possibly sitting into this 130 to 125 area if they report slowing growth, especially on the advertising front. That could be the catalyst to push it down over here. RSI is at the lowest level in years as well. We're sitting, I think, below about 22 or 21 right now is where it's sitting at. So definitely in very much oversold territory. So we just have to see if there's an earnings could be the catalyst to propel it back and break above this key 155 resistance level there.
Okay, Here and Now is going to walk us through a couple of ways we could trade Reddit. But before you get started there, Here, I just want to remind our viewers that options trading carries high risk and may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. What do you want to start with, a bull or a bear strategy?
Let's start with the contrarian trade, which would be the bull strategy here, just given the backdrop of how the chart has been performing, Greg. So if you had a bullish inclination on this stock now, history would suggest, like just based on earnings beats, they've beat over the last 4 quarters on both the top and bottom line, and you felt that this was possibly an area, if the stock did retrace or stayed where it was, a way to potentially acquire the stock, then one trade you could do is an uncovered put strategy over here. Now, looking at the profile of the stock going into this earnings, the expected move based on the options pricing of the at-the-money straddle is pricing about a $21 move either to the top or the bottom. We're currently sitting in the 52nd IV percentile, so volatility has ticked up, of course, this week meaningfully, which makes this trade more conducive because we're looking to sell premium and take advantage of that. So the trade essentially is we're looking to sell an area. If it gets down there where we did identify based on the technicals an area of demand in that 130 to 125. So we're selling right at the 130 put, an uncovered put. And we're looking to collect, Greg, roughly about $5.55 in net credit. So we're collecting that upfront on a single contract over here. And the break-even price, so the way we figure that out is, remember, we want this, essentially for this to play out, we either want the stock to remain in place where it is or stay up and we walk away scot-free with this credit that we sold initially. But on the downside, if we were, our break-even line basically tells us when we would start making a loss in this case. Now, we take the credit minus what the strike price is. So 124.45 is kind of a line in the sand. If the stock does break below and crosses below this line, that's when we would start potentially losing money. And I do have the big reveal, Greg. Should we do it?
Say, because with this one, we should have some assignment risk, right?
We should. You got it. You're getting good at this, Greg. Oh, it's stealing my thunder here. So let's talk about that for a second. Max loss. It's going to be big. The numbers seemed outsized, 124.45, because theoretically the stock could go to zero and we stand to lose everything if we're put to the stock. So that's what our risk stands at. And then, as you mentioned, assignment risk is a big piece of this. Anytime you're a seller of an option, especially uncovered, you're going to have the stock put to you. And that is kind of one of the reasons why you may want to do the strategy, because maybe you don't mind owning the stock at $130. Your net cost would be $124.45, but that might not be the worst thing, especially if you believe in the story that Reddit has to say. On the gain side of it, it's always going to be whatever credit you collect right up front. So what we collect on the onset, if the stock remains where it is or goes up, then we keep the credit scot-free at $5.55 by the expiry date there.
Okay, show me the other side of the trade.
All right, let's go to the bearish. This is really playing up the story that the charts are showing. So if you wanted to play and expect that move on the downside, we've got a long put butterfly spread strategy. So again, the volatility profile, nothing changes, but we are looking to go long. So this is going to be a debit trade. Now, we are looking to just go slightly out of the money from where Reddit currently sits at. Reddit's at about 150, so we're looking to make the move out at the 145 because we expect volatility to be high. Just go slightly out because the options are going to be more expensive typically when volatility ticks up. So we're looking to do the 145 strike put, buy that. We're looking to sell the 125 again. This is matching the area of demand where we think that prices could potentially, see demand come up and being supported. Sell 2 contracts out there, and then just to cover ourselves, we're going to buy the 105. So essentially, what makes this butterfly, Greg? This is the body of the butterfly, the 2 shorts that we have at the 125, and then you have the wings, the 145 and the 105 on either side of it. The wings are equidistant at $20 width right now. Now, the reason I want to do this trade is, one, is just going back to the volatility story, Greg. It's expensive. So the trade by selling 2 contracts of the 125, we've brought this overall trade cost down to $4. That means it's an improvement on our profitability. It means our break even is going to be at 141 on this trade. So we need the stock to fall, but we need it to get to at least 141 before we start making money on this trade. And obviously, max case, we'll talk about that, is going to be if it takes a break right at 125. We want it to, it's almost like a bullseye dart that we want to hit. It needs to stop at 125. If that plays out, we stand to make $16 or $1,600 on a single contract. But if it continues falling down, it's not the worst. We just give up some of the gains we've made thus far. And even if it falls below, goes outside of the lower strike at 105, we still lose just essentially what we paid on the trade at $4 there. And that's why you see that max loss at $4 or $400 in a single contract.
All right, interesting option strategies there for our audience to take a look at. That is the show for this week. As always, investors should perform their own due diligence before engaging in trading. We will be back on Tuesday with the bear bull debate on here, and I'll give it to you.
All right, we got the bear bull. We had to make a little bit of a change, but we are debating Arista Networks, Greg, on this show. So it'll be a good showdown. Of course, a company that sort of is in the infrastructure space of AI. So we'll see how they play out, especially with the shakeout that they had. We did do a proverbial virtual coin toss. Maybe we'll just do.
I witnessed it as well. So I witnessed the legitimacy of the toss.
Exactly. So it's not like we just make up and take it. We actually leave it to chance, and we fight the good fight on the day. So we'll find out on Tuesday who got what side.
Yeah, excellent. We'll see them then. Thanks for watching, and we'll see you on the next Active Trader Live.